Hello and welcome to Accounting and Accounting. This video, which will be in two parts, will cover basic knowledge on depreciation, which you are expected to know for F3 and what you're expected to know for papers higher up like F7 and F9. This video may also be useful for those of you who've had exemptions and might need a bit of refreshing on depreciation or might need further information or reading on the theory behind depreciation. Now in the exam, it's quite unusual to find depreciation on its own as a question. It's usually part of a larger question requiring you to find the net book value of an asset or a class of assets. Most times you're required to calculate depreciation using either the straight line method or the reducing balance method. These are the two most commonly required methods for calculating depreciation, and that's what we'll deal with here. Depreciation is charged on property, plant and equipment, an asset category under non-current assets, which is covered by International Accounting Standard 16, IAS 16 that is. I did mention in a previous blog post that most areas or sections of accounting has IAF, which is standards, rules and regulations guiding the treatment and the accounting of each one of them. In defining an asset, IAS 16 states that an item should be recognized as an asset if it is probable that future economic benefits associated with the asset will flow to the entity and the cost of the item can be measured reliably. It goes on to say that future economic benefits occur when the risks and rewards of the asset's ownership have passed on to the entity. Now that's quite a mouthful. But what this basically means is that if an organization has control being the key word here of an asset, and it also bears the responsibility of looking after the asset, then it should be an asset of PPE. IAS 16 gives guidance on how to account for depreciation. It states that the principle for the basis of depreciation is the expected pattern of consumption of the future economic benefits of an asset. Now what this simply means is that the depreciation charge should be in line with actual expected usage of an asset. Here's a simple question on depreciation. F3 students, please take note, as well as those who've had exemptions and have never had to deal with depreciation. I mentioned earlier that you only have to deal with depreciation either using the straight line method or the reducing balance method. A simple way of knowing which is which or which one the questioner is asking for is to look at what the question says. Now usually if you're asked to depreciate using the reducing balance method, you'd be given a percentage, while most times in straight line method you're usually given just the years. That's the number of years the asset is expected to last for. Calculating depreciation using the straight line method is simply the cost of the equipment or van, as we have here, divided by the economic useful life. Now for the bubble wrap equipment, that's 5 years, so that's $8,500 divided by 5 years, and for the vans is $2,000 divided by 8 years. Now that's for one van, take note. To do that for the two vans, you simply multiply what you get times 2, or you do it twice, whichever one suits you. The question asks for the net book value, so that's cost for the vans, that's 4,000, that's for two vans, divided by 500, that's depreciation times 2, which will give us 3,500. For the reducing balance method, let's have a quick read of the question again. Read the question carefully and note that the bubble wrap equipment was purchased 2 years ago, so it had 2 years of depreciation as opposed to the van, which is purchased new this year. The calculation is pretty much straightforward once you get the hang of it, but it's worth mentioning that the twist is usually in the question. Sometimes you have assets purchased 2-3 years ago and you'd have to allow for the current net book value before you depreciate for the current year. So please do read questions carefully. The bubble wrap making equipment was purchased 2 years ago, so we can assume that they've already depreciated for the first 2 years of its economic useful life. Therefore, in order to get current year's NBV and depreciation, we need to work out the first 2 previous years. NBV as at year 3, which is the current year, is $6,196.50, that's $6,196.50, and the depreciation is $619.65. Read the question carefully and note that the bubble wrap equipment was purchased 2 years ago, so it had 2 years of depreciation as opposed to the van, which is purchased new this year. The calculation is pretty much straightforward once you get the hang of it, but it's worth mentioning that the twist is usually in the question. Sometimes you have assets purchased 2-3 years ago and you'd have to allow for the current net book value before you depreciate for the current year. So please do read questions carefully. Now for the bands, please pause the recording here and try to work it out yourself. You calculate depreciation as 10% of the cost, then subtract that from cost. Your answer should be $3,600 or $1,800 per band, that's for the net book value, and $400 for both bands, or $200 for depreciation for each band. We've come to the end of this recording. Thank you for listening. Please practice as many past questions as you can find. Go on the ACCA website, buy textbooks, and practice. You can only get better